You have likely seen the real estate trend online. Buy a multifamily home in Florida, live in one unit, and let the tenants pay your mortgage. The math is a primary draw. Using an FHA loan, a buyer can purchase a 2, 3, or 4-unit property with a down payment as low as 3.5%. But successfully funding the loan requires surviving a strict underwriting gauntlet that those 60-second videos often omit. In Florida, the friction is uniquely high. You are spanning strict federal lending guidelines directly into a volatile state property insurance market. If you don't anticipate these barriers, you risk burning thousands of dollars on lost inspection fees, only to have your loan denied weeks into the process. High accessibility to a loan program does not mean easy qualification, and operating a multi-unit property is an active job. To close on a duplex or fourplex, you have to understand exactly how FHA underwriters evaluate you and the property in the specific order they do it. The first major mistake buyers make is looking at the published FHA county loan limit and treating it as their personal shopping budget. This chart shows the 2026 FHA loan limit for a 2-unit property. In South Florida, that total reaches $853,900. But that limit is just what FHA will insure. The lender determines your actual approval, reducing that total based on your personal financial obligations. Then you hit the Florida factor. High premiums for wind, flood, and hazard coverage are a mandatory reality of buying property here. Those insurance quotes are factored directly into your proposed monthly housing payment, which consumes a significant portion of your allowable debt-to-income ratio. An FHA loan also requires its own mandatory mortgage insurance. That adds another permanent layer of cost to your monthly payment, reducing your approval amount further. Ultimately, your actual buying power is dictated by your existing debts and your specific local insurance quotes. The top-line HUD county maximum is rarely the amount you will actually be approved to spend. Recognizing the high cost of entry, many buyers try to scale up. They target triplexes and fourplexes, attempting to maximize their rental units while keeping that low down payment. The leverage is significant. The national floor limit for a fourplex sits at over $1.04 million, all theoretically accessible with 3.5% down. Moving to a 3 or 4-unit property triggers a rigid roadblock, the self-sufficiency test. It mandates that projected market rents for all units must cover your entire monthly housing payment. If the property's math fails this test, the loan is automatically denied. It does not matter if you have a high W-2 income and perfect credit. You cannot use your personal salary to save the deal. The property must pass the test independently. Lenders also require you to hold documented post-closing cash reserves for 3 and 4-unit properties, strictly to ensure you can survive potential tenant vacancies. Maximizing your unit count forces you over an unforgiving mathematical hurdle. It evaluates the property's rent potential alone and neutralizes your personal wealth as a deciding factor. Finalizing the purchase marks the end of the acquisition process, but it is day one of your life as an owner-occupant landlord. You are now strictly bound by Chapter 83 of the Florida statutes, the laws governing residential landlord-tenant relationships. You have to handle emergency repairs, properly hold security deposits, and process potential evictions, often while living right next door to the tenant. Then you face a primary financial trap for new Florida buyers: estimating your budget based on the previous owner's property tax bill. Florida property taxes reassess based on your new purchase price. That reassessment can cause a spike in your monthly payment, which can wipe out your expected net rental income. You do get one major state benefit. Because you occupy the property, you can claim Florida's homestead exemption on your unit, which shelters up to $50,000 of assessed value from tax liability. FHA multifamily ownership in Florida is a legally binding second job, exposed to volatile tax resets. The myth of passive income breaks down immediately upon closing. This chart maps out how to navigate these options. FHA multifamily loans provide significant leverage, but they are high-scrutiny financial products. If you are an entry-level buyer working with a conservative budget, you should target a duplex. A 2-unit property allows you to secure the 3.5% down benefit and collect rental income without triggering the 3-4-unit self-sufficiency test. But if you are an optimizer determined to maximize your unit count and rental income, targeting a triplex or fourplex means you must adopt a defensive posture. You have to stockpile cash reserves well before you start making offers, and you must obtain realistic insurance quotes during your initial inspection period. Most importantly, demand that your lender runs the self-sufficiency math on day one. Do not wait until the final week of underwriting to find out if the property qualifies. Survival in Florida's multifamily market requires building your strategy on post-purchase tax estimates and strict HUD math rather than optimistic marketing claims.